What's going on, everybody? We are back with TradeUI, and in this video we're going to go over how 2 simple lines can make you a better trader. Before we do that, don't forget to like this video, share, and subscribe. It really helps us grow this channel, and throw some comments down on what type of videos you want to see us make so we can make sure that the content we create is relevant to you and your trading needs. Don't forget that we have a Discord that you can join as well. That's in the link below. Go ahead, join us. That way you can trade with us in real time and we can all profit together. So now we got all that out the way, let's talk about the 2 simple moving averages that we're going to go over, which is the 50-day moving average and the 200-day moving average. So the moving averages are going to be the average price that a stock has been trading at over the past certain amount of days, depending on the one you want to use. The 50-day moving average talks about the average price over the past 50 days. The 200-day moving average talks about the average price over the past 200 moving days. So both of these are pretty good indications on where a stock's trading at. However, when you can use both of them together, you can really become a better trader and understand when's the best time to get in on a trade. So let me show you exactly what I'm talking about, and let's look at some real life situations to where you could have been making some awesome profits as a trader. So in this chart over here, I have AMAT as my first example. What I want to do is go over to studies, and I'm going to go to edit study. So when I edit a study, I'm going to add 2 simple things, which is the SMA, stands for simple moving average. I'm going to add 2 of them. So I'm going to double click it twice. Let's see here, there we go. And as you can see, we have some information here. The daily SMA is going to talk about the close, the day. It's going to say 9, 0, and no. We want to focus on the 9 here. The 9 is going to, that's the number of periods that is going to actually generate that line. So I want to change that. When I go to my little gear icon, I'm going to change that 9 to 50. And then I'm going to make it bright orange just so I can see it. And then this one right here, I'm going to go down here and I'm going to change this one to 200. And I'm going to keep that one at bright blue. So whenever I apply these, I'm going to show you a very consistent pattern that a lot of traders take to become awesome swing traders. The first thing you want to see is the orange, if you're bullish, is the orange line, the 50-day moving average, trading above the 200-day moving average. That means the overall sentiment is bullish, and if you ignore these lines, you can easily tell this stock is going up and is bullish. So now let's figure out the best times to get in on this stock. So you always want to look at support and resistance levels and understand for yourself how long you're wanting to hold a trade, etc., and things like that. We have other videos on support and resistance lines. I want to focus on just using these 2 simple lines. So if the orange line's above the blue line, we're looking for bullish opportunities and we want to buy the dip. Well, a very conservative dip for us is going to be anything testing this 200-day moving average. In this case, this area right here is a great time to buy AMAT. And as you can see, throughout the rest of the next couple of months, this thing went from $134 all the way up to $210. But you may be asking, well, how do I know when it's time for me to get out? There's a couple of different things you can look at that. One is you can draw support and resistance lines. You can see 150 was probably a good target because we hit it once here, and as you can see, we came back and tested for a little while. Or you could just say, I'm going to hold this thing till this stock turns bearish. And then you're saying, well, how do I know when it turns bearish? Well, when this orange line starts to cross below the 200 line, that's when you know that the stock has officially turned bearish and you should only be looking for short positions. So when it comes to taking profits, that's going to be on who you are as a trader and how conservative you want to be. In this place, I probably would have held this as a long-term entry. This is great for long-term investors and swing traders understanding the best time to buy dips, because right here, the momentum of the stock is bullish and there was an awesome dip. We have bullish indication because this orange line actually held above the $200 line, the 200 moving average line, and it kept going up. But you might just think, Lane, that's just one stock. I mean, come on, show me something else where this is actually consistent. All right, well, I'll just type in another one. Let me think of DOCU, DocuSign. Okay, so DocuSign, this is a pretty good example of knowing when to get in. So right here, the orange line crossed below the blue line. So this is actually bearish. So we should only be looking for bearish opportunities in the market. However, I do not like to bet against the overall markets. I only like to look for buying opportunities and I like to buy dips. So I really don't personally try to short sell anything. So I'm not looking until this orange line goes above the 200-day moving average, which is right here. So now that this stock is above the 200-day moving average and the orange line's above it, I can be looking for opportunities when the stock is getting close to the 200-day moving average. In this case, it got to here around $52 to $50 a share, and as you can see, it looks like we're looking pretty bullish because you would have bought 52 and it went right up to $58. So you can kind of figure out your own strategies when it's to get time to get out. If you look, we had some resistance here, former resistance support here, and it's here. I'll draw this line out so it makes sense. Let's see here. And it lines up right around 58. So you could have bought right here around that $52 level, and then you could have easily targeted $58 or until this orange line started to cross below the blue line. So plenty of opportunity here in the markets. All you have to do is be vigilant and look for these crosses, and it just takes time and practice and reviewing your charts, guys. I mean, it's as simple as looking at INTC. Let's see, because I know we've done a couple videos on Intel in the past. So Intel, let's see, right here is in a great time, or right here as well, because our orange line crossed above our blue line, and we immediately started going right around this 200 moving average level, but our orange line's still above. So this is a buy the dip opportunity, and as you can see, it went, even right here. It came back and tested again to where you could do one of two things. You could have said, you know what, I need to lock in this short-term profit if that's when you got in, and make that $2 a share. Or what's $2 a share on a $30 stock, guys? That's a great move. That's like, I think, I don't know the math right off the top of my head, but I know that's a couple percentage points up. Especially less than a year, that's a great position. But you could have actually averaged down right here and bought more at 32, and then you really would have taken advantage of a big move to the upside. However, you got to draw your support and resistance lines to figure out where strong targets are. Right now, we're tracking this one in real time, thinking 42 is a good opportunity. However, if we're looking really conservative at this, $40 to $39.35 is going to be even better of an opportunity where we could average down and buy more to probably $50 a share. But let's look at one more before we close out this video here. I'm just going to see, let's do Ford, all right? Ford. Okay, Ford's a good example of why you got to be cautious and make sure that you're not betting the house on every single trade. So, right here, we're looking for bullish opportunities, which is right now on 6/30. So anything past June 30th is bullish opportunity. So you would have started looking at buying right here on 7/31 a month later. Could have bought around $12 a share. And honestly, this is one of those where it's not always accurate, right? Like you're down 50 cents to almost $1 right here, and you would have came back, and as soon as that simple moving average crossed down, which would have been right here roughly, so 2 months later, you would have realized, you know what, this stock is going south on me, it's time to move on. So if you would have got it at 13, you would have took a 30-cent loss because of the way this setup happened to be. However, guys, you got to risk what you're willing to risk on each trade. That comes out to different strategies you can use. But what I do want to point out is where Ford's at right now. Right now, we're actually about to cross above this blue line again right here. So now we could be looking for some potential buying opportunities. Me personally, I want to find stocks that are not doing a bunch of crosses up and down. I want to find that one big cross point. In this case, this is getting set up for a bullish cross point to where we could see another run up to 1450. So this is something you keep your eyes on. But let's end on an easy example. Let me see if I can think of one off the top of my head. Let me think of Google, GOOG. All right, Google. Google is a great opportunity here. Okay, so the good thing is no matter how far the cross was, the system still works on when it's a great time to buy. In this case, we had our bullish cross back in May of 2023, and the only time you really would have wanted to buy Google is right here back in March of this past year when we got down to that $135 level. Now we bought here, you would have said that was a safe bet, and you would have made, what was that, 15 bucks a share only in a short amount of time, guys. Like, it is awesome how powerful this simple strategy is. Now, it's not going to be for my day traders who want to get in and get out and make a couple $100 in a little bit of time. This is one of those for if you want to pick your own investments or longer term swing trades. This is a great strategy that you can implement, but you got to follow these rules, okay? Rule 1 is to make sure that you wait for that cross to go up or down. So once that 50-day moving average crosses above the 200, you're looking for buys. But you're not buying until that stock goes to that 200-day moving average. That's the only time you're looking at buying. Now, the next thing is understand how much you're willing to risk and how much you're willing to win on that risk. So that's our R multiple, okay? If we want to risk $1 to make $2 at least, that's how we stay in the game longer. So if you found something to where I was trading at 50 bucks and you're saying, I want to ride this thing to 60 bucks, you have to cut your losses at 45. That means risking 5 bucks a share to make 10 bucks a share. If you can implement those two methods, you can always find opportunities in the market. Because, guys, all these setups happen and react the same way with most of the stocks out there. So just stay vigilant, hunt for those winners, and one day at a time, you'll become a more profitable trader. Once again, guys, I appreciate the time you spent with me on this video. This is an awesome one I wanted to make for y'all. Don't forget to subscribe and turn on the notification bell so you can check out more videos and more great content when we make it. We're going to end the video here, guys. Have a great day.